My name is Michael Guyad, publisher of the Lead Lag Report. Joining me for the hour is Craig Hemke, not Turd Ferguson, apparently, given his handle. Craig, introduce yourself to the audience. Who are you? What's your background? How'd you get interested in markets? And why the focus on gold and silver in particular?
Oh boy, that ought to take up all of our time, actually.
I want to make my life easier by just listening to you, is what it is.
Yeah, you can go get a cup of coffee, and and I do have a habit of getting long-winded. I do a podcast for my subscribers every day, where it's just kind of a monologue of 20 minutes talking about events. So if I can talk for 20 minutes, pretty easy. Anyway, thank you for the invitation to come on and join you. First of all, I appreciate it. My background, I began my career as a stockbroker. Are there even stockbrokers left? I'm not sure. In about 1990, that's how far back I go, and transitioned to a couple of different other roles within the securities industry. And then around about the time of the financial crisis, I had a great awakening. I was, early on, someone who was reading Zero Hedge when it was still a blogspot site. And I had to join. I wanted to interact with all the different prop desk traders and everybody else that was there. So I had to join the site and pick a name and an avatar. And I settled upon Turd Ferguson. But nonetheless, people there, the members there, the commenters there encouraged me to start my own site in 2010. I've been doing that ever since. Began trading commodities when I was in college, mostly the grains because I grew up in Nebraska. The focus turned to gold and silver in about 2009 when QE took over, and we started this whole brand new financial paradigm that we've been in ever since. And you don't have to focus on the metals very long to get a feel for, these are a little different. Some different stuff going on here than what I'm used to seeing in other markets. And then that, again, kind of drove me in this direction. Now this site's been around for almost 13 years. It's a great community. It's a global community of people from all political stripes, but we're all kind of in the same boat trying to ride out this economic storm. And I think that's what makes the site probably most valuable.
Since you mentioned 2009 when you got more focused on gold and silver, I'm curious to hear your thoughts on why is it that I think it was a couple of years after the GFC, golds and precious metal kind of topped out. I mean, I remember that time fairly well. A lot of people were very big on gold. A lot of the gold bugs came out because the argument was that this is, a new paradigm shift with quantitative easing. Why is it that ended up being sort of the opposite type of reaction by the precious metal space, you think?
I think we can maybe compare it and contrast it to what has actually happened now since 2020. In that first round of QE, and I'm not sure, and I put myself in this camp, I'm not sure everybody understood it. We knew this was different. The Bernanke was going in front of Congress saying we are not monetizing the debt, even though we're buying treasuries, that sort of thing. And everybody thought it was going to lead to rampant inflation. And I put myself in that camp too. And what we now, as we've come to understand it, and maybe Bernanke was kind of right. They were mainly just buying crap mortgage-backed securities and at premium prices, we now know, that were actually priced at nickels or pennies on the dollar, and here the Fed was paying 105 and 110 for some of those, and just kind of swapping out new dollars for these garbage securities on the balance sheets of some of the banks. And in a sense, a lot of that cash that they created was quarantined, to use a COVID era term. And it didn't come flooding out. It didn't cause a Weimar Republic type of hyperinflation. And so a lot of folks rushed into gold, and silver too kind of followed along in 2010 into 2011. And then even with the advent of QE3 in 2012, the metal stopped going up, and actually the dollar started going up. And that's always one of the fallacies of all this too, is the dollar's measured versus other fiat currency. And so they all kind of devalue together relative to each other. They look like they're unchanged. And so the dollar started going up and commodities all fell in 2013, and we all kind of wandered the desert for about 5 years. But then the most recent pause and pivot from 2018 and 19 was that first realization, I think, from the generalists and hedge funds and the wider global investment community. Wait a second, the Fed, this really is a new paradigm. The Fed is just going to print their way out of every time there's a problem. They're not going to There's none of this Fed credibility, the Fed pulling back, the Fed, going to reduce the balance sheet back to 1 trillion, all that stuff. I think people started to figure out in 18 and 19, particularly 19 and then into 20, that wait a second, they're full of crap. Hold on. So then you get, the trillions and trillions of QE that now this time is different. Direct payments, direct cash, direct support, to people that went out. And thus now we've had this massive price inflation. And that's why it's a little bit different this time versus 2010. And that's why this probably now has more legs. That and then this now a more greater understanding that the Fed really is full of crap and that there is no going back. They will attempt to print their way out of everything. And I think that probably keeps us at these levels and going higher now for quite a while.
It's amazing how sentiment often plays into key reversals, right? So as I recall, around the prior peak of gold's price, and people can fact check me on this, but I think there was a major headline story. I think Trump was the first one to basically make the case that he was accepting gold in exchange for payment of properties, right? And I kind of vaguely remember this. Somebody can Google it and fact check me on this. But I saw that, and I remember writing for Marker Watch at the time. Whenever I would say something about gold, whether it's positive or negative, the engagement was through the roof, right? The gold bugs would come out very fervent in their sentiment. And a lot of that went away, right? You can argue it kind of switched to the Bitcoin side, the cryptocurrency side, that sort of ardent emotion around the thesis. Given that gold's gotten some movement here, I'm just curious, are you seeing increased engagement? Are people still skeptical? What's some of the feedback that you're getting from people that track your work?
Well, the longer term people are all battered and bruised, right? We know what we're up against on a daily basis. And what I call the fractional reserve and digital derivative pricing scheme that's used. And so that leaves us all kind of jaded from years of this. I have not sensed, I see things on Twitter where people are like, oh yeah, gosh, the sentiment of gold, everybody's bullish now. All of a sudden, yeah, I don't know about that. I mean, you might get one segment like we got on CNBC yesterday, but until you're, the proverbial cab driver is telling you where and how to buy gold, I'm not too sure that we're at any kind of peak of sentiment yet. You mentioned Bitcoin. I do think that's an interesting component to this too. I tend to think of this as the asset managers of the world have like a bucket in their minds, where there's, as they're trying to generate their alpha, and they have all these different buckets, that they want to put money in. And there's kind of an alternative currency bucket, non-dollar bucket in their minds that might get 1% of their assets, or God forbid 2%. And in that bucket was always just gold and the gold miners. And then all of a sudden, as you mentioned, Bitcoin came into that picture, and the bucket didn't get any larger. You just carved off. I'm just going to start using all these different metaphors. You carved off a piece of the pie and gave it to Bitcoin. Then in 2020, that pie was cut up even more with crypto garbage. All the different, little Ponzi coins and everything else that came out that siphoned money that would have gone into gold and the gold miners, siphoned it off again. I do think in this next rally, I would be surprised if there was another big rush into crypto type investments. Bitcoin, a whole other story. I own Bitcoin. And I think Bitcoin and gold can be owned together. But I just wonder if that crypto share of the pie is going to be less, this year and next in this next rally. And if that won't lead to more dollars coming into gold. In the end, what we're all kind of waiting for in just even a traditional generalist sense is for gold to get, instead of just 1% of the global asset allocation, just get 2%. I mean, these are tiny markets. I mean, the entire GDX can be bought for a couple $100 million. It's not very much money, a couple $100 billion, I should say. And so if the spigots get turned on, and gold's breaking out to new all-time highs, and people start getting interested in owning non-dollar related investments to some extent, then again, going from 1% to 2% global asset allocation is a lot of cash searching for not very many investment opportunities, and relatively speaking, and it's that can really kind of ignite the fire. We're not anywhere near that yet.
The asset allocation part is, I think, really important to flesh out, and that's why I named the Twitter space the way that I named it. Gold really doesn't correlate to anything, right? So I'd argue that it's the ultimate diversifier, just from a pure quantitative perspective. And to the extent that asset allocators believe that you're in a prolonged bear market, they'd want more diversification, less beta in a portfolio, which probably means some, residual demand into things like gold. How much of this movement in gold price is related to institutional rebalancing on the idea that maybe we're in a decade that's going to be difficult for beta beyond the short-term pontifications around the Fed?
Well, in the signs that we can measure, the things that we can see, there hasn't been much yet at all. Maybe a little bit in the last couple of weeks. But say, for example, the total contract open interest on COMEX for gold is still down. It's like 470,000 contracts. Michael, that's been as high as 800,000 contracts back in the day. Even back in 2010 and 11, when gold was rallying, through 1800, it was 650,000 contracts. I mean, we're 2/3 of that today. So now, maybe we can ascribe all kinds of reasons for that, but that would suggest that there's still not much institutional, because, and again, you could maybe look at like the GLD as a proxy that some like Stanley Druckenmiller likes to use as his gold position. Even that, the tonnage in that is not near its all-time highs, and so I'm not sure we've yet even seen. You make a good point. Don't get me wrong. That eventually major institutions and hedge funds and the like may want to diversify, or however they want to look at it, by owning some gold in some form. But I'm not sure we've even seen that yet. And so I'm not making it. I don't want to make it sound like I've got all these reasons why gold's going up. Gold's going up for a host of other reasons that will then drive institutional ownership. But this notion that just because gold's rallied so far this year and is at an all-time high, that somehow it's like hyper bullishness, and extremely overbought, and I don't think that's the case at all.
No, and by the way, just to be clear, I mean, I agree with you 100% on that, right? The thing with cycle changes is that you don't know the cycle has changed until 2 to 3 years after the cycle's changed, right? So if the cycle's now started for gold, most people are not going to even think that that's a secular bull market until a good amount of the move has probably already happened. But since you mentioned that point about kind of a host of other reasons, let's talk about some of those other reasons that gold is moving beyond just the price go up, right? There's you always need to have narrative to get early adopters, right? And there's maybe a new type of early adopter here. So what are some of the new narratives that are starting to form, you think?
I might ask, we're on Twitter. My Twitter handle is @TFMetals. And my pinned tweet, I do this every year. I write like an annual forecast. I call it a macro cast, because really, if you're going to get gold right, you got to get the macros right. This idea you can trade and swing trade and count your waves and all that stuff, I just think, to me, I can't do it. I'm not sure anybody should try. But I think if you get the macro right, get the general direction right, then you can ride all that out. Gold's annualized since the turn of the century about 12% a year. So if you can, get the macro right, you can do okay. So I write this forecast first week every January. It gives me a chance at the end of the year to kind of cobble my thoughts about what has happened, look back at what I got wrong the year before, and then hold myself accountable, to say, here's what I was thinking, and I can't hide from it. So it's right there at the top of my Twitter page. My profile page is the pinned tweet. That's a link to that forecast. And when I wrote it this year, Michael, and I think this is, I thought when I wrote it in January the 4th, I thought this was critical for people to understand, and it's critical now. And people, I think everything's kind of coming around to my view of all this. This year is a lot like 2010 and 2019. Both of those years began under this umbrella of perceived Fed tightening and rhetoric about how responsible they are, and you got to believe them. And back in 2010, QE1, which came out in March of 2009, was a one-off. It was never going to happen again, and the balance sheet was going to go back to $1 trillion, and rates were going to normalize and all this stuff. And then we got into a period of economic contraction in the middle part of that year, and by November 2010, here comes QE number 2. Wait a second, I thought you said it was never going to happen again. And so in the first half of 2010, gold and silver mainly went sideways. But they began to anticipate that by the summertime. And then I think everybody knows what happened. I mean, gold went from all the way up to 1900 from about 1200. Silver went from 18 to 48 trying to play catch up. Then you go fast forward to a similar time was the end of 2018. The Fed was, again, playing all these rhetorical games about, Operation Twist had been a big thing, right? And they were going to be hiking, and you had all these Wall Street economists like Jan Hatzius at Goldman Sachs talking about 5 more rate hikes coming in 2019 and blah, blah, blah. When instead you had this massive liquidity crisis. The stock market collapsed in December of 2018. You got the pivot or the pause, at least, that happened then. And by June of 19, here came the rate cuts. And that, people were talking about the 10-year note going from 2.5 to 4.5 in 2019. Instead, it went from 2.5 to 1.5. And so what happened? Gold and silver went sideways for the first half of the year, and then they took off and then really accelerated in 20 with all the COVID stuff. And so here we are again as this year begins, right? Oh yeah, 4 or 5 higher rate hikes, higher for longer, Fed balance sheet getting trimmed, normalizing, whatever. Give me a break. I've seen it all before. As soon as there's any hint of economic weakness, any hint of liquidity problems, the Fed rolls over. And that they're doing it again right now. I mean, again, this was obvious, but yet everybody gets so caught up in the urgency of the headlines and the last person they saw on Bloomberg talking about something, and some bullshit-filled 8-figure Wall Street economist comes on and tries to tell, come on, give me a break. Anybody could see where this was headed. I'm sorry, Mike, here I go, right? This is my 20-minute monologue. But again, this isn't complicated. They've done this countless times before. They were going to do it again. This was the only thing that they know how to do. And so when the Fed, which bases all of everything they do off of models, right? And it's run by goons like Bullard, who in 37 years has never had a job outside the Fed. All they can do is look at their models from their scores and scores of economists crank out these models. When they go down a path last year of rate hikes, that's unprecedented, that they've never done before at that rate. There are no models for that. I mean, they're just simply flying, instrument flight rules, playing with all the dials and all this. They have no idea where they're going, but yet they try to tell you that they do. And it's like any objective person could look at that and go, you go from 0 to 4.5 in the course of 18 months. That's probably going to cause some problems. And now all that stuff is starting to reveal itself. And so, again, I apologize for the long answer, and getting back to the macrocast, that's what I laid out in the forecast this year, that we'd probably go sideways for the first 4 to 6 months of the year in the same flag consolidation phase that we've been in for the last 2.5 years. But then we get this recognized breakout. First, probably in gold, and then silver would follow like it has in the past couple of times. And now maybe that's what's happening now. It may still not be happening yet. But again, you get the macro right. You don't have to worry so much about the timing, and I think we're getting the macro right.
How much of the recent movement here is due to the, in quotes, regional bank crisis, which I keep going back to is somewhat manufactured, provides an excuse for stimulus, I'd argue. Right. And I keep going back to this point. It's like, as everything was happening with Silicon Valley Bank, I said this is, the Bitcoin maxis kind of wet dream around counterparty risk. But interestingly enough, gold actually kept on, doing its thing, right? It's not like money went into Bitcoin and gold didn't participate. What are your thoughts on sort of concerns around the banking system and how gold responds under that type of, continued theme?
I guess there's 2 different ways to look at it. In a fundamental sense, in terms of rationale for why gold would go up, again, you can look at that and go, well, okay, yeah, no doubt. This is going to impact whether the Fed's going to continue to hike, and now they're going to start printing again and all that kind of stuff. So you want to get in front of it. But probably the bigger change, on an intraday basis is, again, we're talking about the futures contracts and how they trade in New York and whether there's demand for them. And the demand comes from the high frequency trading machines and the hedge funds. And a lot of it is just like the stock market. Michael, you know this probably better than I. What's a daily volume of the stock market? 90% of it is HFT, 85%, something like that. The same thing is true on COMEX. And so, these intraday moves up and down, whether they're, and whether you can string a couple of them together, are often driven by the factors that drive the machines. Is the bond market rallying and, getting lower nominal or lower real rates? Is the dollar going up or down? And that drives these high frequency trading machines to either buy or sell the COMEX futures contracts during COMEX hours. And so with the Silicon Valley Bank, and then, First Republic, and then Credit Suisse and all that stuff, the big shift within that paradigm was a rally in the bond market, right? The 2-year note went from north of 5 to under 4 in a period of days, right? 10-year note went from north of 4 to, what is it now, 330? That's a huge move in interest rates, and that's and again in real rates too. And so that drove a pretty consistent bid for the futures contracts. The dollar has been tumbling. It went from 114 down to 101, and then rallied in February back up to 106, and now it's back down to 102. So that is wind in its sails as well. And so, in understanding the day-to-day kind of supply-demand function of the futures contracts, it's those inputs. Now you get the bigger trend, the fundamental stuff that I started with, that either is getting you to buy the dip or sell the rally. But the idea that, and this kind of promotes what you were saying earlier about gold being kind of independent and non-correlated. Gold's looking at other things, to drive that futures price rather than other things than maybe the other markets and other investments might be looking at. Does that make sense? I'm sorry, I don't want to talk myself into a circle.
Yeah, no, and it's just speaking about, since you mentioned the way that yields responded. For the last 10 years, I've heard that argument that one of the reasons to be bullish on gold was because it had a higher yield than bonds. Right, zero was more than negative, right? When it came to a lot of these negative yielding type of sovereign issues, and that wasn't really a good reason. And the irony now is that now that you've got yield across the entire bond space, gold is getting much more attention and traction. I'm curious if you have any thoughts onto why that is. I mean, to me, that's sort of just classic in terms of the way markets tend to do the exact opposite of what people think.
Well, I suppose there's some to that. I think I've seen in all the years I've been doing this, there's a real misperception still that that to hold about gold being just an inflation hedge. That gold goes up when inflation goes up, and gold doesn't go up, if inflation is flat. That's only partially. You're almost there when people say that. They're almost there, but they're missing the key component. Because if that were the case, then gold should have been soaring last year. And I get a lot of people saying, "Why is it gold going up when CPI is inflation's 8%?" What gold really is closely correlated with, I mean, like a 95% correlation, is real interest rates. The difference between, and again, it's not even the stated inflation number. Again, these machines are tracking the difference between inflation expectations, the break-even rates versus the nominal interest rates. And so stated inflation is a part of that calculation of real interest rates. So that's why people are kind of partly there when they think of it as inflation, but it's really determined by real interest rates. And that is, I think, we're getting back into that negative real interest rate mind frame. Not so much the nominal rate being 1% or being 4%. It's the real rate that's now trending back toward the negative. Because if the Fed is going to have to yield, and they are, toward easing without getting CPI inflation back down, then you get this rally in the bond market, which drives nominal rates lower, but yet inflation expectations stay higher and sticky. And now we're back into, even based off of expectations, a negative real rate structure. And it is in those negative real rate periods that gold really soars. And so it's not so much about nominal rates, and it's not so much about the stated month over month or annualized inflation rate. It's the combination of the two, and whether the inflation adjusted real rate is positive or negative, that ultimately drives whether gold is going up or down.
Everybody here, please make sure you follow Craig Hemke on Twitter and check out his research on his site. Let's go to my friend.
It gets to that pricing scheme again. And the connection between this price that's discovered through the trading of derivatives and then the actual physical metal that has to be delivered at that price. And how this, like I call it a scheme, that maybe that's too, for me, it's not too strong of a term, but maybe for some it is. Look at copper. There's this major disconnect in copper. Goldman Sachs came out and said a couple of weeks ago that the above ground available stockpiles of copper may be drained by August, not August to 26, August, like 4 months from now. And yet copper runs up against a short-term trend line last week and immediately falls back under 4. So is this price that's derived through the trading of the futures contracts, which is all done by these just speculating hedge funds, is that accurate versus the actual physical supply-demand picture? We're about to find out, apparently, according to Goldman. And again, you can see this in the global stockpiles of copper. They're down probably 90% over the last 10 years. So, how does, as that translates into gold? I mean, and I might speak about this because, again, this has been all part of what I've done now for over a decade. Gold used to trade in a physical only market, and it was pegged to a certain price. Most people know this coming out of World War II and Bretton Woods. The price was managed to $35 an ounce, and then even $42 an ounce. And the U.S. had to manage that price and convert dollars into gold because the dollar was freely convertible into gold. And by the late 1950s, and it only took whatever that is, 12 years, there were hearings on Capitol Hill. The U.S. had ended World War II with 25,000 metric tons of gold. And they lost a third of it in the first 12 years from countries that are accumulating dollars that come to the U.S. and say, we don't want these. We'd rather have the gold. So here's 35 of your paper and we'll take an ounce of gold. And we lost a third of our gold stockpile in the first 12 years. There were hearings on Capitol Hill, all this craziness. Fast forward then to 1961, where the U.S. says, okay, we're not going to do this alone. We're going to 7 other countries. We're going to pledge a bunch of physical gold into London, and we're going to manage the price there, called the London Gold Pool. And every time gold goes above $35, we'll dump a bunch of physical on the market. Anytime it goes below 32, we'll buy it back. A little bit like what Biden was trying to do with the SPR this year. Now they haven't bought it back. Okay, so then that worked until 1968 when, again, there was so much demand, it just drained that and blew it up. So now what are we going to do? There's clearly not enough physical metal to try to maintain this peg. Nixon closes the gold window, and then the bankers got involved and said, hey, guess what? We finally can do alchemy. We can pretend that these futures contracts are just as good as gold. And if people will believe that, if people will say, oh, yeah, I've got exposure to gold. I own a futures contract. I'm never going to take delivery, but I got this futures contract. That's exposure to gold. Then we've done alchemy. We've doubled, tripled the amount of gold because all of a sudden these contracts are good. The GLD. Hey, look, I own gold. I own the GLD. No, you don't own Jack. No, I own the GLD. All these unallocated accounts that are run by mints and dealers around the world. Another form of alchemy. And so when you trade these futures contracts, is that really indicative of what the actual physical price is? See, now I would suggest that it's not, but there are a lot of people that would suggest that it is. And so I don't know if I've answered question with another one of these lengthy monologues. I'm seriously, I'm not just trying to dribble out the clock. Just get me started. I've had a couple extra cups of coffee and here we go. But that's, in the end, that's what most of us, if you're going to call me in the gold bug community, you know what we want to know? We want to know what the price of gold is if you remove all of the fake stuff, the phony baloney stuff. If Stan Druckenmiller's got to actually show up and instead of buying the GLD, he's actually got to buy physical metal itself. What's the price? There are probably, there's at least 10, if not 20 or 50 people that own the same ounce of gold in the world. They think they own it and they don't. There's maybe 100 different beneficial owners, if you want to call them that, for each ounce because of this fractional reserve system. When that leverage gets unwound, that's kind of what we're all we're all waiting for.
I tend to be skeptical of most things. I mean, it's just part of my personality. But yeah, you often hear this idea that gold's price, silver's price, that they're manipulated because of exactly what you said, all these different instruments, and it should be a lot higher. And as these institutions are accumulating, the central banks are accumulating, they're maybe anticipating that there's going to be a big spike. Um, as maybe somebody who claimed to be a gold bug, like you just said, do you give any credence to the idea that there's this kind of active manipulation around pricing?
I think that you still see it on a daily basis. It's not, we now have convictions. The former head of JP Morgan's global precious metals desk, Michael Nowak, who is also on the board of directors at the London Bullion Marketing Association, LBMA. He's been convicted. The sentencing recommendation is 5 years in the hole, him and about 5 other guys, for spoofing. Well, it's just spoofing. Everybody does. Look, that's active manipulation on a daily basis. And the banks do this because they are, we'll call them bullion banks. They are the ones that are responsible for flowing physical metal into delivery at the price that is derived through the trading of the futures contracts. Most of that delivery takes place in London. It doesn't take place in New York. They just trade the futures contracts in New York. There's a charade of delivery that takes place every month there because you got to have some delivery. Otherwise, what do you have? You might as well just be trading baseball cards. But the delivery, the physical flow is through London. And so that's why this Nowak character runs at JP Morgan's or had run the JP Morgan metals desk, but also was on the board of the LBMA. It's like a hand in glove. And so the banks are in there on a daily basis. Hell, you saw it today. They're in there on a daily basis, managing the price around their order book. Okay, they're looking out for number one. They are the ones, you can see it in the CFTC reports. They're the swap dealers. They are the ones that are always short because they are the one, either it's their own metal or it's the metal that they've hedged for others or whatever. They are the ones that have to manage manage the derivative price to that physical price every day, based off their order book. So this goes on every single day. Now you could say is it manipulation? Is it management? I no longer think when I first got into this, there was still, we were still early in the QE game, and you can make the case that maybe the Fed and the U.S. government didn't want a higher gold price because it's a reflection of a lack of confidence in the dollar. So therefore, they have an interest in having the price go down. Yeah, okay. I don't think that's so. I think they've got bigger fish to fry at this point. I don't think anymore the Fed, maybe even not even the biz, has that much of an interest in gold. They've got bigger worries. But I believe, again, remember I mentioned earlier, Michael, I said you don't have to follow gold and silver very long and make it your sole focus before you realize, and this is some weird stuff. This stuff does not trade. Doesn't trade like stocks, doesn't trade like bonds, doesn't trade like Forex, doesn't trade like the grains. Gold and silver are a totally different animal. And you watch them on a daily basis, you'll figure that out. And so the manipulation, if you want to call it that, or management of the price or whatever, is ongoing. It doesn't mean it can't go up. And it doesn't mean it's not manipulated to the upside at times. Just as recently as last month, and this happened 4 times last year, there was a massive short position on the speculator side that built up in silver. And so while everybody was talking about silver going to 14, it got down to about 18. And then there were these ripping short squeezes where the speculators were short and the banks were long. And this just happened again in February, again, by the Commitment of Traders report. So speculators got short like 17,000 COMEX silver contracts, and the banks were long 17,000. Well, guess who's going to win that? And again, this massive squeeze comes again, and we go from 20 to 24 or whatever, 25. So it goes both ways, but there definitely continues to this day. There's still money to be made in managing the price, and the prop desks of these bullion banks are the ones that are attempting to do it. And again, Michael, I should say, this is not, and I think most people realize this, they do this in equities too, right? I mean, these massive prop desks, at Goldman Sachs and the like, I mean, they're all in there trying to build winning positions to fatten their bonus pools, right? So it happens in the precious metals too. And that's why, again, none of that should surprise anybody that it still goes on.
Well, I mean, it happens in the economy. I mean, the Fed is manipulating things. Right. So it's not like, I guess it's sort of legal manipulation versus illegal manipulation.
Yeah, there you go. It's a good way to put it.
But okay, and then maybe for the last question, since you've got to hop off early, Craig. And again, everybody, please make sure you follow Craig Hemke here on Twitter. Of all the different metals, obviously we touched on gold quite a bit. Gold is unique; it's more of a risk-off safe haven play. You touched on copper, silver. Is there a part of the metal space which looks really more explosive in terms of upside potential, either because it's not being talked about or there's some interesting sort of supply demand dynamics that is not in the mainstream?
I'm really curious to watch these base metals this year. I just saw something yesterday, I think it was yesterday, about aluminum and aluminum stockpiles that are apparently being depleted as well. And the global stockpiles, we're combining Shanghai and London and, New York and around the world of copper, lead, nickel, zinc, aluminum are all massively trending downward. And let's talk about copper specifically because it's such an important base metal. What'll be interesting to see if Goldman's right, and we are really that close to being drained of all above ground copper. What if again, the easiest example is just to say you're Tesla as a product producer, and you've got to have copper. I mean, if copper is it's just an input to your product, and you can't finish your product without it, and you get wind that there's a shortage, you want it now. It's almost like a bank run, right? You find out that your bank's in trouble, you run to the bank to get cash before everybody else does. Well, what if you find out that what if there really is an impending copper shortage? You run and you get your copper. Trafigura, I think I pronounced that right, big commodity trader. And they announced back in early January, they were withdrawing like 3/4 of their copper from the LME because they wanted to be sure they had it to deliver versus forward contracts, that they were short for the first half of this year. What if you get this kind of bank run, be it in copper or aluminum, zinc, nickel, whatever, that could very easily extend then into the precious metals, I should say, into platinum, palladium, and then gold and silver, because they're all pretty much structured the same. You've got physical delivery at this futures derivative contract price. And if all of a sudden there's a problem with copper and copper goes crazy and copper breaks out of a 5 and makes new all-time highs and all of a sudden it's going to 6 and all that kind of stuff, that's going to spread. And all of the other metals are going to go up. And this kind of awareness of these depleting stockpiles tends to accelerate it. So again, another long answer to a short question, Michael, but outside of the precious metals, I would keep a real close eye on all of the base metals, but particularly copper, because it's so important and so in demand, not just, in the US and the West, but in China as well. And again, if global stockpiles are being depleted as quickly as some suggest, that may get really crazy before the end of the year.
That's a good place to wrap this Twitter space up. Again, everybody, please make sure you follow Craig Hemke. Really do appreciate it.